So thank you for what I'm absolutely sure was a very informative and enlightening speech. I think I got the key part, which was we need, all the graphs are pointing up to the right? We need much more power. We need it reasonably soon, and we need it to be produced by renewable sources and preferably locally and where it's needed. Which is lucky because that's what we've been doing for the past 12, 13 years at AIP, investing into the energy transition. With that as a segue, let me first of all give you a quick introduction to myself, to AIP, and then I'll dive into why energy transition investments make sense from an institutional investor perspective, how we've done it at AIP over the past dozen years, and some of the lessons learned, and hopefully some of that can be useful and inspiring here. And if you have any questions along the way, feel free to interrupt and ask anything really. So quick introduction to AIP. Who are we? Well, myself, as mentioned, I am the managing partner of the firm. Been part of it for the past decade and building this platform with institutional investors. Prior to that, spent a decade in private equity across Europe and North America. Prior to that, some growth capital and some venture capital. So been going from high-risk ventures to growth capital to private equity and now to long-term, boring, stable infrastructure. So growing up slowly. At AIP, we're dedicated to investing in the energy transition. We're based in the Nordics. We have offices across Copenhagen, London, New York, and Madrid to be able to find the best possible investment opportunities. And we've done that so far, investing into 29 assets and investing 8 billion euros into those. Those assets, importantly, generate a good long-term stable return, but also renewable energy. So far, 25 terawatt hours, and that's enough on an annual basis to power 6.2 million households, which is actually twice as many households as in our little country of Denmark. And also enough to power Iceland, I'm sure. So that's the quick introduction to myself and to our platform. It has evolved gradually since 2012 when we were founded by PK. So you could say this company has always been built by and for and with institutional investors. So we've been set up to invest very large sums of money from those balance sheets to secure long-term stable returns. Started with PK with the ambition and idea from the beginning to set up something that multiple investors could join so that we could enjoy the scale benefits of pooling the resources, pooling the capital, and building a specialized firm to deliver the long-term investments that multiple pension funds in Denmark initially, and then across the Nordics and Switzerland wanted. So we've been raising money over the years from increasing number of investors, but still a relatively few in the Nordics with those large balance sheets. In 2018, we established AIP Management as a separate entity owned by myself and PK. And last year, Storebrand, large Norwegian insurance, pension, bank, financial asset manager acquired a majority and continue to deploy capital through our platform. We have, of course, given how and what we invest in renewable energy, signed up to just about any, you could say, formal reporting and good investing standards. But it's a continuation of how we were set up initially, because that's part of the reason the pension funds wanted us to do these kinds of investments. I think you said doing well by doing good when we met this morning. So that sort of dual purpose and bottom line has always been part of what we do. This is what we've been up to the last 13 years. Lots of data, lots of information on the slide. Obviously won't go through everything. But just to say, consistently across those 13 years, since we started in that little dot number 1 in windy Denmark, just outside of Copenhagen, in a partnership with what was then Dong Energy, now Ørsted, world leader in offshore wind. Since that beginning, we've invested in partnerships. So what goes across this slide is the name of the partners in each of our investments, because we truly believe in teaming up with the best and getting complementary skills in and around these sometimes very large and complicated projects. So Dong Energy became Ørsted. We've invested alongside a number of different pension funds in Denmark, teamed up with other large pools of capital like on Burbo Bank Extension, another Ørsted partnership with Kirkby, that's the Lego family money, also investing big in renewable energy to offset their global footprint. In the US, we've teamed up with Long Road Energy, that's a developer of various onshore wind and solar and storage projects. So repeat partnerships to be able to help the developers deliver more projects and do it efficiently by repeating the same governance, the same contract structure with a partner that we know and trust. And then we've been very gradually expanding from Copenhagen to Germany to the Benelux to the UK, so small circles of increasing the comfort zone. And also in terms of subsectors, so offshore wind, onshore wind, solar PV, storage, and more recently also in electrification of transport, so putting the good power to good use. But a very consistent strategy, and one thing in addition to partnerships that goes across all of them is scale. This is complicated, but there's not huge returns. It's good risk-adjusted returns, but it needs to do it at scale to keep the cost down. So the investments here range from 250 to 300 million euro each. It's the same piece of work whether you invest 10, 20, or 1,000 million. So you better get it scaled up so you can make it cost efficient. This is what we've delivered in a snapshot. This is in euro, obviously, so it's a decent spread over this period, very, very low risk-free rate. I'm particularly proud of, and I know our investors are very happy with, two things here. It's the 9% stable long-term cash yield over that period of essentially next to no interest rates. And then it is, as mentioned before, the 6.2 million households supported by green electricity, which turns into more than 10 million tons of CO2 emissions avoided annually. That dual purpose is very important for us, for our investors, for everyone on the team. It sort of makes it extra fun to go to work and an extra motivation. So very, very proud of that metric. Now, why do these energy transition investments make sense or relevant for institutional investors? Well, in one sentence, they can provide long-term contracted cash flows, downside protection, inflation linkage, and that's what makes infrastructure attractive for institutional investors, also in today's volatile environment. It's sort of the bedrock of a portfolio if you've got 10 years of contracted cash flows. Now, I should add, if done right, because it's also been quite evident over the past 2-3 years how much risk has actually been taken in some of these ventures and projects over the decade prior. If you get your risks assessed right and that you take the ones you should be the right owner of, it is a good asset. If you take much more risk than you can tolerate over the cycles, obviously there will be a price to pay. We're on the boring, downside, resilient end of things, so we haven't been suffering too bad and can still deliver a good cash flow. But what are these investments in these assets? Essentially, it's infrastructure, right? It's physical assets they're central to the local economy, and we invest where there's good power market fundamentals, where there's high barriers to entry, so you cannot just replace that particular asset. There is a high degree of contractedness, which means visibility of cash flows over the long term, and ideally inflation linked, so you get to the real cash flows you want. And that is for a large balance sheet with inflation linked liabilities, obviously a good hedge for the long term. Now add to that, at least in our approach, established partners. So we have a team that knows at least some aspects of this industry and what we do, but we always look for and lean into and invest with established partners that can add other skills to that particular project. And that in combination gets to those stable cash flows and returns that are rather uncorrelated to just about any other asset on the typical pension fund balance sheet. So the inflation linkage, diversification benefits, and the stable cash flows. That's essentially what it all boils down to. I could add, get it to scale to enable it to be cost efficient as well, because there can be quite a lot of costs in setting up these investments and platforms. Now, I won't repeat what I'm sure was covered in some degree the last half hour. There are some very big drivers pushing for more renewable energy, and therefore a very, very big need for demand for power and capital to get that power established. Now, luckily, it is now also affordable. At least most technologies in most locations, if you get the right combination, you'll get the lowest cost of energy. Not as cheap as you have it here coming out of the ground, essentially, but in most countries, either wind or solar will be cheaper than any conventional and fossil fuel, which is indeed a good thing. Now, that is very important, and even more important now with rising cost of capital, with rising component cost, because economies are getting stretched. It used to be a sustainability game, sustainability drive. It needed a political push to a large degree to get the offshore wind industry, you could say, off the ground or out of the water. We still need, from a sustainability perspective, to invest material amounts of money in the energy transition. But actually what's driving it now, we feel, is the economy. It's about affordability and then also about security. So making sure that we are independent from certain suppliers of energy that we wouldn't want to be dependent on. And you could say security has many aspects. One is political, which regimes or systems do you want to back. Another is as simple as information security. Data centers will get built where energy is available in abundance and cheap. That is in certain locations in the US, that is in certain locations in the Middle East, and it's here. I'd much rather have mine and my family's data stored on a server on Iceland than in the US or in the Middle East. So please keep building more energy, building more data centers so we can have the data trusted here locally rather than in places where, I don't know. Again, you can draw many stats and charts. They all point upwards and to the right. We need more power. This is one way of showing it, and is really on the left-hand side, showing the decarbonization approach or angle that we take as well. Where can we get the biggest decarbonization bang for the buck? Where are the emissions coming from? What can we solve for? And our investment focus is really, you could say, hitting or solving for 80% of the CO2 emission sectors across the EU and North America, being massively power generation and transport. So how have we done this? And some lessons learned, both the easy success stories and some of the more the bumps on the road. Now, I mentioned it before, gradually, and some say we're moving at the pace of dinosaurs when coming into new things. We're thorough, we take our time. We spent the first 5-6 years investing into offshore wind only in Northern Europe. We added onshore wind, we added solar, we gradually added the US when we had spent a couple of years getting comfortable with finding the right partners. We've added electrified transportation because putting the renewable power to good use makes a lot of sense and makes it all more circular. And then in recent years, we've added more on both grid investments, storage, which is in certain markets becoming a bigger and bigger trend and need to make more renewable power come into the grid. And we've added what we call industrial decarbonization. So in energy intensive industry, it makes sense to electrify where you can electrify. But actually, if you cannot electrify, then take the next step and go to a molecule. It could be hydrogen in very few use cases because it's been hyped beyond belief. So gradually expanding the comfort zone in terms of which technologies to be able to invest in. and really doing it across, you could call it the end-to-end decarbonization or the supply chain or value chain of power, and it becomes circular, right? Because we need lots more renewable power. We need it to be transmitted to where it is needed and stored to when it is needed. So the storage and grid infrastructure. And in other islands like the UK, there's so much wind now, they've phased out all of the fossil oil, at least all the coal. So the base load is a much smaller percentage of the grid. They have much more wind and they're adding solar, so intermittent sources. They absolutely need to get that grid balanced, so they're in very good conditions now for investing into storage, humongous batteries. And in the last 6 months, we've invested in 4 storage assets in the UK with a total of 3.6 gigawatt hours of capacity. So really quite a few households that can then get power even if it's not windy. So Trump's not right. The TV's still on even if the turbines aren't spinning. And then at the end, electrify anything that can, decarbonize industry, going from green electrons to green molecules to replace gas and coke and coal, for example, in green steel production. You could say this is the same chart just flipped as a pyramid, but what we're focusing on is really that middle stack. Of course, first of all, avoid and reduce energy consumption. The best electron is the one not needed, not used. So a lot of energy efficiency can come in as very, very attractive investment areas, but typically much smaller and in different business models than we consider infrastructure. Generate the power, electrify what you can, and if you can't electrify, go to, for example, green hydrogen. We're not focused on carbon capture, usage, and storage. We don't think standalone on its fundamentals. It doesn't stack up. It needs a subsidy. It needs someone with a willingness to pay. Then it can make sense if you can, for example, capture the CO2 emissions that are absolutely unavoidable in cement production, or sort of in very few and select applications. But we really focus on that middle bit to get renewable power for electrification. And then the classic fundamentals tests for an investment. Is it an essential service to society? Are there high barriers to entry? Is it in stable economic regions? So we stick to the EU, North America, to generate robust cash flows for the very long term. And then that sort of third test is this the best pathway to get the most effective decarbonization, so the most decarbonization bang for the buck? Because that means in the long term, you'll not end up with a stranded asset that was only held up by a subsidy for X period of time. I mentioned this before, but it's an important one to hammer home from our perspective. We work with strategic partners, and we do that for a number of reasons. To add complementary capabilities, because we know, but we're also very aware that we don't know everything, we can't do everything. We're a good financial partner, we're a good informed investor, but we do need to invest with others that can add a completely different skill set. Together, we can get the projects financed and built and operated, and with a clear division of risk and responsibility. We're not cut out to be a developer and take the risk of, will this site or that site become the best for this particular project? We don't want to operate on a day-to-day basis these projects, these assets, these companies. There are people that are much better at that than we are, so they should do that and be rewarded for it. And we can take some of the big picture long-term risks like production estimates, like macro factors, like how markets evolve and move. But we always look for a strong alignment with the partners we're operating with, because we believe that gets the best long-term outcome. If all the people around the table are focused on and sharing in the reward for the long-term performance of the asset. That's best done through economic ownership alignment, so actually having a share in the equity, all of us. You can do it through various types of contracts, and you can allocate risk in an EPC contract, an O&M contract, but it has its limitations. If you own a part of the project, you care, really care. I'll show an example of that in a second. Here's one example. It is a very big project. It is one that I'm very proud of. I was involved in making this investment happen 9 years ago. That's not true, 8 years ago. But we spent an awful lot of time with Ørsted, one of our premier partners at AIP. This was, at the time it was put into operation, the largest offshore wind farm in the world. It's called the Walney Extension because it is an extension of an existing much, much smaller project. It was a big, bold, ambitious development project in the early days, initially. And it was then awarded a very attractive contract for difference by the UK LCCC company. So supported by an attractive CFD with tier 1 suppliers and the best partner in the world in Ørsted, and with a very careful contract structure, meaning the allocation of risk and responsibility was to the best partners around the table, made it an infrastructure investment with very stable cash flows. It started with a very ambitious and risky development project and became a very investable infrastructure asset through a long negotiation and careful structuring. And in total, the enterprise value of this project at signing was 4 billion sterling. So a rather massive undertaking, and quite a few people came together to fund and finance it. It's now supporting almost 800,000 UK households. It would be more in Denmark because we're slightly more energy efficient, but still. That leads to almost 500,000 tons of CO2 emissions avoided per year. Now, for us as an investor, we and our partner in this, another Danish investor, PFA, each of us invested 355 million pounds, so rather sizable, which meant we could deploy a lot of resources to really fully understand all of the aspects of this. And we have to date earned a 10% return, so the investment has actually today paid itself back in full. And we still own our share in it and are enjoying a cash yield of about 10% per year, at least until the end of this CFD contract, which we're halfway through. And then it's a merchant project, but we'll already have earned a, you could say, secured return and have some upside and long-term equity share. It's also an example of a partnership between a public utility that was actually cash constrained at the time. They are again now. In between, they made a ton of money, but still, they came from a point of being dung energy, transitioning from oil and gas into renewable, specifically offshore wind. They had a lot of development projects. They couldn't fund all of them themselves. So that public utility and developer projects partnered with institutional investors with lots of capital and coming together really to enable the build-out of what became a very sizable offshore wind player on the world stage, and a lot of good assets that are generating a good return for the pension savers. So quite good example of that partnership model, that combination of bringing the various skill sets to bear. And it's an investment that brought half of the partners in the AIP together. We're 10 partners, co-owners of the firm, and 5 of us spent a good part of a year on this deal. So we got to know each other quite well. So, key success factors, if you want to do this, what worked from our perspective? Cheating to say, but we were lucky that PK recognized early on, our largest investor at the time, the need for a specialized team with relevant knowledge and industry expertise and the relationships in that industry to actually find the good partners and identify the good projects. We have been very focused since the first day and built a team that's specialized within what they do. We've from time to time been pushed towards doing much more earlier on in the US, doing offshore wind in the US, which I'm pretty happy we said no thanks. We've been pushed to go, why don't you do all this in Asia as well? It's going so well. I wouldn't know how to begin to figure out how to win in that market. We have got enough to do here in Europe, and we can apply this model in the US. But really focusing and specializing, I'm a firm believer in. And then these repeat partnerships. Treat them well, and over the long term, that'll be rewarded. And then I think I mentioned before, but fundamentals, get the fundamentals right. Pick the right partners, I know I'm repetitive on that point, but it's really important. Be clear about what kind of risk profile and risk tolerance you have as an investor. And from our perspective, that, for example, means if we're in a project with shared construction risk, multi-contracts, complicated offshore wind build-out for 6 or 9 months, don't add financial leverage, at least not during the construction phase, because it just amplifies a risk which you can tolerate much better without leveraging it up. I've got a few examples of some of these points. On Prospero, which is the first one here. Now this is my investor relations team writing this, so it's active asset management and transforming adversity into advantage. Very fancy words, but actually all this says is Longroad Energy is a repeat partner. We have 3 investments together. They service multiple renewable projects, including the ones that they are co-owners with us in. And, excuse my French, when shit hits the fan, I know which projects they prioritize. It's not the ones where they have an O&M contract or an asset management contract only. They have that here as well. But they own 50% of the equity with us. So in this case, when a hailstorm hit and destroyed 330,000 panels, we were sort of slightly surprised. A hailstorm in Texas. It happens apparently, and more than we knew. We were well insured, so that took care of a good part of it. But rebuilding 12% of a site with panels that were relatively, at that point, outdated. So the new panels they were building in factories were much bigger. We've been a different rack, different inverter technology, complicated mess. But because Longroad really cared in this particular project that they were co-owners of, they used their local relationships to find a supply of exactly the same panels that were destroyed to that volume, plus we bought some for next time this might happen. They managed to get the same contractor to come back and rebuild the site, all within the envelope of the insurance, while we renegotiated with the tax equity partner to structure it slightly differently. So we came out of a hailstorm that destroyed more than 10% of the projects with a slightly better project and a slightly higher expected return. But I'm absolutely sure that wouldn't have been the case if we hadn't had a local asset manager on the ground that also owned some of the equity. So that partnership alignment, really, really important. Eitt, which is an example of that, don't add risk to construction. We're still building this site, so we're not through the woods yet, but it is gonna be the largest offshore wind farm now, not in the UK, but in Germany. We've partnered up with the EnBW, local municipality-owned developer of offshore wind. Not the most experienced in the world, so we've actually put our technical director in to oversee in the committee overseeing all these contracts. And we put together, to avoid adding leverage to this very, very large project, and because our partner preferred to keep 50% stake to consolidate it into the balance sheet without consolidating the leverage. We did it unlevered, but we could only do that by teaming up with some pretty nifty partners. So together we found Allianz and Íslandsbanka, or NBIM, some very, very sizable balance sheets looking for exactly the same long-term stable returns, unlevered. And we could then offer to EnBW a one-stop shop for 1.3 billion euro of equity, which meant we could negotiate in a slightly different way than you would through a banker-led process, and we were not dependent on financing. So we're now building this project together, and to secure that stable cash flow for the investors, EnBW have guaranteed a 15-year pay-as-produced PPA. So every electron generated by this project will be sold through EnBW at a fixed price. So we get to the stable cash flows we're looking for. And then just to the scale of these, it's 15 megawatt turbines, the largest ones Vestas makes. It used to say actually a single turn of these could power a Tesla 3. That's not politically correct anymore, so now it says can power 200 smartphone batteries. So one rotation of one of these 64 turbines can power up all of our phones twice. It's big scale. And the last example I'll mention, and then I'll open for questions, but it's just pick your approach to the markets you're entering, because they're very, very, very different. Spain, neighboring France, is a completely different power market. The dynamics down there now are such that when the sun is up, the power price is zero, because they've built so much solar into the grid in such a short span of time, without the grid and the storage and the load side actually following. So the investment case for equity there is questionable. And it happened very, very quickly. And they're still adding 5-7 gigawatts per year, because the projects have been commissioned and financed, and they're happening. But they're feeding into an oversupplied grid. France, on the other hand, is undersupplied. They have a fundamental need for power. They're importing power from other countries, and they're held together by 44 nuclear reactors that are on average 40 plus years old. So they really need a new source of power, and lots of it. So we've been trying to find ways to enter the French market for quite some time. And in Finland, we found a partnership with this French developer, logically. So we financed one of their Nordic projects. They were a good developer. They built the project on time. It is now in operation. We've signed a PPA with Google. All good. They came to us and said, could we partner on another type of financing where you invest in our holding company, because we need more capital to build out our pipeline in France. And we're like, fantastic. We've been trying to enter France for a long time, but haven't found the way to do it. Because once you get through the development pipeline and process, which is extremely complicated there, 7, 8, 9, 10 years of local hoops and hurdles, you get rewarded, if the project's done well, a 20-year contract for difference with the French government as the counterparty. That's still a reasonably good credit risk, but and inflation linked as well. And because they're so short on power for the long term, those PPAs or CFDs are clearing at 84, 85 euros a megawatt hour. So it's a fantastic revenue certainty to build projects into. And this machinery that we found in Valorem is a company that's done that for 30 years. They know their ins and outs and ways around. The local farmers, the local government, you need to get everybody on board to back these projects to actually happen. And once they happen, you've got 20 years of fixed cash flows. So we invested into Valorem as an approach to a market which is otherwise impenetrable from a foreigner. And because I didn't dare go into that market alone as a Nordic naive investor, we teamed up with 2 local French institutions that invested on the same terms as us. So we have local eyes and ears on the ground, not just at the management level, but also at the shareholder level.